20 billion a year, do we need to invest anything? No. The simple answer is no. Is our reputation on stake with that risk? No. Do we still need to do it? No, we don't. So, it's basically very subjective, depending on the organization, depending on the risk limit, depending on the business that you're in. You are the people who need to assess that risk. Then put it in writing, calculate it. How much is the loss? What is the loss exposure? When you calculate the loss exposure, and then you go back to your management or your directors or the company owner and say, this is the risk, this is the losses that we can make by not implementing our risk policy, they will be on your side. And then you can ask them to implement the policy. When it comes from the top, it is accepted. You can go along and challenge everybody else in the company. It will not be as effective as if it comes from the top, from the stakeholders, from the shareholders, from the board of directors. I'm sure we all experience that if the circular comes from the top, we will read it. It comes from somebody at our level or comes from somebody junior, put it on the side tray. Not to say that I do it, but it's just that it's normal practice. Risk avoidance, mitigation, and reduction. If product instrument has a greater risk than the bank set limit, then highlight it to the management. Now, as a financial controller, financial accountants, and the area that we're working, if it's not your company, then you can only highlight the risk to the owner, to the stakeholders, to the shareholders. We cannot push it to them, say, you have to have it. Also, no, sorry, I don't need to have you in the company, please leave. So we can emphasize the problem to avoid the risk. I've mentioned some terminologies here, product and instrument. In banking, there are different products like loan products, hedging products, infrastructure-related, loan syndication. All of those people who are familiar with the banking terminologies will understand. For the rest of the people, if you have any questions, please ask me that how we do mitigate risk within the banking environment. The main thing is the set limit. There is a loss limit set in a treasury department in most companies, especially after the fall of the Barings Bank. People have decided that if you are making loss more than 5% within 3 months, then you need to revise and check everything in your balance sheet. The other one is mitigation, which is insurance. So we can avoid certain risk. I'll go back to the first one just to complete it. How we can avoid risk is a few different things. One, don't do the business. You avoid it completely. Don't do the business. No risk. But then you also lose the gain that comes along with it. So what do we do in this situation? Well, we measure the risk. How much is the risk? No sane investor would go into a transaction where you tell them that 80% of chance of losing your money, only 20% gain. I will not, certainly. I will put my money where I will gain 100% and the risk of loss is about 5%. And that's the reason we keep the money in the bank, not with our neighbors who would guarantee us the double money tomorrow morning. You won't do it. Huge risk. No reputation, huge risk. Any company coming up, say, give me 1 million, I'll give you double tomorrow. I wouldn't bet on it. The problem is that we know there's an inherent risk in there. With the banks, everyone knows secure investment. Insurance policies, secure investment. With the reputation of several years, when you look at it, tomorrow somebody, ABC insurance company comes up. I'll insure your car, I'll pay you triple the amount of your value. You won't do it. So those are things that we need to avoid risk. So risk avoidance in few areas that don't do the business, then you lose the benefit. Take the business along, check the risk. What's your risk exposure? How much you can risk? How much is the loss if you go into that risk situation? So we do the calculated thing. That's all what accounting and accountants are about. That's what, if you are in the finance department, that's what it's all about. It's about numbers. We don't believe what people say. We believe in numbers. If it matches, if it does, great job. Otherwise, we'll all be entrepreneur, taking huge risk. Mitigation is kind of avoidance, but with a coverage. To give you a simple life example is, if it rains, you go out with the umbrella. That's the risk mitigation. So you see the weather wrong, the risk is you're going to get drenched. To keep yourself dry, you carry the umbrella, whether the rain stops or it stays on. You have the coverage with yourself. Similarly, companies go out in the business world, they insure their transaction. Financial market, insurance companies, they insure the transaction. Say, for example, if a ship, PNSC, they insure their cargo ship before it sails. No ship in the world, apart from if it's a pirate ship, that's a coast of Somalia or something, they don't leave the shore. They don't leave the port without the insurance. And insurance companies have been established since 17th century in England, so they started. So even if they know that for the next 50 days, there is no storm, there is no chance of any malfunctioning in the ship, they will still insure. There are 3 or 4 different insurances a ship has. Cargo, personnel, ship itself. Then you have weather insurance. I mean, it's a whole mine of things in the shipping industry. Hedging instruments. People who worked or are working in the Treasury Department will understand more, or their focus will be on the hedging the risk. Treasury Department normally basically defines the finances of your company. They hold the money. They are the custodian of the money. Now, a company having 20 million or 50 million pound excess or dollars, what do they do with it? Just earn the interest? Well, there are better ways to make more money. So what the Treasury Department do is basically they go out, they buy the products, like FX products. So if I'm trading in US dollars and I'm paying in Pak rupees, what would be my hedge? That's what Treasury Department need to think about. So they would buy the currency swaps in the international market. They will buy something that will cover the Pak rupees and the US dollar currency swaps. So if the exchange rate moves up, I'm still covered. I don't need to lose money on the exchange side. Or the other way around is Treasury would go into the country where you're investing. They would take a loan out in the same currency and invest it in the same currency. So there are different techniques which to cover FX losses, foreign exchange, which companies use. There are different things on that. So that's a whole thing which is about FX strategies. Reduction, ops losses can be reduced by implementing control and monitoring methods such as risk register. This is a very important tool. If you do not record something, you don't know. Some of you might have a very good memory, but organizations don't have good memory. Organizations have written or electronic media memory. And that's what they work on, because if you leave as the human asset of the company, the moment you leave, you take all that important information with you. Therefore, the risk is the problem that was in the past is gone away now. When you're not there, nobody knows about it. And for people to know and monitor where the risks are moving, you need to have a risk register. There's a small example in an Excel spreadsheet which I've embedded in here. It gives you event number, event code 2, which is basically internal fraud is IF, external fraud, system error, external fraud, internal fraud. So IF, SY, IF, these are these. Code is just, I've just given something to fill up the thing. Cost center, I'm not sure how many of you are familiar with the cost center exposure within the organization. So you have different cost center where you allocate your cost. So these are the cost center where loss has been occurring. Business line could be credit finance, asset management, trade finance, and rolling banking finances, things like that. Loss. So we have, this is the most important column. How much is the loss? What we have recovered. Say for example, somebody ran away with your money.